Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Today on the show, we're going to talk about whether or not you should choose a Roth or a traditional when it comes to either your IRA or 401k. Likely, this is a question you've asked yourself or maybe might have asked your financial advisor. It is by far one of the most common questions. And I'll say this before we get started on some of the considerations to go through when it comes to this question. The reality is, to me, is one where I think it's the eye of the beholder, because frankly, as an advisor, I can see it both ways. Again, we're going to focus on these considerations that I think you should look at. But at the end of the day, what is really important is to have options when it comes to your retirement bucket planning. And we're going to talk about that here in a second as well. But before we do, make sure to smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. So first and foremost, let's talk about what the difference is between a Roth and a traditional. The primary difference here between investing in a Roth retirement account and a traditional retirement account is when you pay the taxes. This all revolves around taxes, okay? Mind you, many of my recent episodes, if you've noticed, have a lot to do with taxes. Now, we still are technically at the tail end of tax season right now, so it's still a topic that I'm sure a lot of you are going through right now. But a lot of investing in general has a lot to do with taxes because you care about what? You care about your net after-tax returns. So as an advisor, a good advisor should care about this. And so the main difference here is how and when you are taxed. There are a few things I think you should know when it comes to traditional. Let's start there. First, in a traditional account, you don't pay the taxes on the money you contribute now, but you'll pay the taxes on the money when you withdraw it, let's say in retirement. The idea here, friends, is that you'll be in a lower tax bracket in retirement than you are now, so you'll pay less in taxes overall. That's the general thesis that Roth and traditional stand on. Now, the inverse is true of Roth. In a Roth account, you pay taxes on the money while you're contributing, or before you're contributing really, and then when you withdraw the money in retirement, it's tax-free. Now this I think is great for people who really have the concept that tax rates will be much, much higher later in life, or for people maybe who will be very wealthy, I think, in retirement. So you can use that to adjust and play what I call the bracket game, adjust your marginal tax bracket. Now there's some things here to know before making a decision that I want to share on our show, just some considerations that I think is important for you. First and foremost, contributing to a traditional retirement account can lower your taxable income now, which I think, by the way, is very valuable to a lot of people in a higher tax bracket if you're there. That's number one. Number two, I think a healthy mix of pre-tax Roth, and I'll also add maybe even an after-tax account or taxable account, I think will give retirees and ultimately everyone out there probably the biggest degree of control. Let's say with your tax rates or just your tax in general, whether again, it's now or in retirement. Remember, don't feel like you need to put all your eggs in one of these baskets either, right? Or these buckets, if you will. Many of you heard me talk heavily about bucket planning. And I think it's important to have different types of asset classes, whether it's traditional, Roth, after tax, maybe life insurance, cash value, maybe cash or CDs, maybe real estate. There's a lot of good aspects that come into having multiple buckets in retirement. So end of the day, you're thinking, Brad, which one of the decisions should I make here between Roth and a traditional account? This will all largely depend on your individual circumstances. That is the truth, okay? Anyone who's out there saying this is for sure this way or it has to be done this way, be wary. Remember, it has to do with your specific circumstances, basically including things like your tax rates, your income, and ultimately your goals for your money. That said, there's a good rule of thumb I want to share with you. And that rule of thumb is this. Use traditional accounts during your peak earning years, maybe your higher income years, okay? And then Roth accounts, maybe when you're younger, whether or not you're listening here, whatever age you are, use it then when you're not earning as much or you haven't hit those peak potential years, but maybe you're even between jobs, whether age you are, for example, or going part-time or otherwise earning less just in general. Then maybe over time, as you're higher earning, you switch to a traditional to get those deductions during those tax years, something to consider. So you have, again, at that point, if you did both, you have both buckets. Again, great conversation to have with your tax advisor or your financial advisor, and make sure you do so. And if you'd like our help, you can reach out to us. Our number is here on the screen. You can also scan the QR code. That'll get you in touch with us. I do hope you enjoyed the show. If you did, make sure to subscribe to our show and always make sure to make your money matter.